Most traders think the RSI indicator predicts the market. It doesn't. That's the first mistake. RSI does not tell you what price will do next. It tells you something far more useful. It reveals the condition of the crowd right now. And if you learn to read that condition correctly, you begin to see opportunities that most traders completely miss. Have you ever noticed how traders become most confident near the end of a move? They buy aggressively after a strong rally. They panic after a sharp decline. Yet those moments often produce the worst entries. Why? Because markets move in cycles of enthusiasm and exhaustion. This is where RSI becomes valuable. When RSI pushes into overbought territory, many traders immediately look to sell. When it drops into oversold territory, they rush to buy. But the market is rarely that simple. Strong trends can remain overbought for longer than most people expect. Weak trends can stay oversold while traders keep trying to catch a bottom. So what is RSI really telling you? It is measuring the speed and intensity of price movement. Think about that for a moment. If a market is rising so quickly that RSI reaches extreme levels, what does that tell you? It tells you buyers are highly motivated. Not necessarily that the trend is finished. That distinction changes everything. The experienced trader does not ask, is RSI overbought? The experienced trader asks, how is price behaving while RSI is overbought? One question searches for a signal, the other searches for evidence, and evidence is what matters. Suppose price makes a new high, but RSI fails to make a new high. Many traders know this as divergence. Yet the real importance is psychological. The crowd is still pushing price upward, but momentum is no longer expanding. The engine is running, but it is beginning to lose power. Does that guarantee a reversal? No, markets guarantee nothing. But it tells you to pay closer attention. Cause and effect. Momentum weakens first. Price often reacts later. Now consider the opposite situation. A market falls sharply. RSI becomes deeply oversold. Fear spreads. Traders want out at any price. But then price stops making meaningful progress lower, even while pessimism remains high. What are you really seeing? You may be witnessing selling pressure losing effectiveness. The crowd is still emotional, but the market is no longer responding with the same force. That observation is often more valuable than the RSI reading itself. So how should you apply RSI? First, never use it in isolation. Second, study the relationship between RSI and price structure. Is momentum confirming the move or quietly warning of weakness? Third, pay attention to repeated failures. If RSI reaches extreme levels multiple times and price can no longer extend the trend, something important may be changing beneath the surface. Most indicators are treated like prediction tools. RSI becomes powerful only when you treat it as a behavioral tool. It helps you understand the condition of participants, not just the direction of candles. Most traders look at RSI and immediately ask one question, where is the market going next? That question sounds reasonable, but it often leads traders in the wrong direction. The RSI indicator was never designed to tell you the future. It doesn't predict the next candle. It doesn't guarantee reversals. It doesn't know where price will be tomorrow. What it does measure is pressure, and that distinction is far more important than most traders realize. Think about how markets move. A market doesn't rise simply because buyers exist. Buyers are always present. A market rises when buying pressure becomes stronger than selling pressure. Likewise, a market falls when selling pressure overwhelms buying pressure. RSI helps you observe that battle. When RSI begins climbing, it tells you that upward pressure is increasing. Buyers are becoming more aggressive. They are willing to pay higher prices. Momentum is building. The market is responding to that demand. But does that automatically mean price will continue higher? Not necessarily. This is where many traders make a costly mistake. They confuse pressure with direction. They see a high RSI reading and assume a reversal must be coming. Or they see a low RSI reading and assume a rally is guaranteed. The indicator never made those promises. Imagine a strong uptrend. Price keeps advancing. Every small dip gets bought quickly. Traders who miss the move are eager to enter. Confidence grows. Momentum accelerates. What happens to RSI? It moves higher, not because the market is about to reverse, but because buying pressure is dominating the market. The indicator is reporting what is happening right now. It is describing the current condition of the auction between buyers and sellers. That understanding changes how you interpret every RSI signal. Instead of asking, should I sell because RSI is overbought? Ask yourself a different question. What is creating this strong pressure? The answer often reveals much more than the indicator itself. Have you ever noticed how some stocks remain overbought for weeks while continuing to climb? Traders keep waiting for a reversal that never arrives. Why? Because pressure remains strong. The market does not care that RSI reached a certain number. As long as buyers continue applying force, price can keep moving higher. RSI is simply reflecting that reality. The same principle applies during declines. When fear enters the market, sellers become increasingly aggressive. Positions are liquidated. Stop losses are triggered. Panic spreads from trader to trader. RSI drops sharply. Many traders immediately see an oversold reading and rush to buy. But what if selling pressure is still accelerating? What if the crowd is still dumping positions? In that case, RSI is not telling you to buy. It is telling you that sellers currently control the battlefield. Pressure first, direction second. This mindset helps eliminate many emotional decisions. Rather than reacting to every RSI extreme, you begin studying how price behaves around those extremes. Is buying pressure expanding or weakening? Is selling pressure increasing or fading? Are market participants becoming more aggressive or more hesitant? These questions lead to better observations, and better observations lead to better decisions. The traders who consistently survive in the market are not the ones searching for magical indicators. They are the ones who learn to read the forces operating beneath price movement. RSI can help with that, but only when you stop treating it as a crystal ball. It is a pressure gauge. Just as a pressure gauge in a machine tells you how much force is building inside the system, RSI tells you how much momentum is being applied by market participants. It reveals intensity. It reveals urgency. It reveals when one side of the market is gaining control. One of the most expensive beliefs in trading is the idea that overbought means sell. It sounds logical. If a market has already moved up significantly, surely it must come down soon. If RSI enters overbought territory, many traders immediately begin searching for short positions. They assume the move is exhausted. But the market does not work that way. In reality, some of the strongest trends spend a surprising amount of time in overbought territory. Not because the indicator is wrong, but because traders are interpreting it incorrectly. Have you ever wondered why a stock continues rising even after RSI reaches extreme levels? The answer is simple. Strong buying pressure is still present. RSI moves into overbought territory when price has advanced with unusual strength and momentum. That condition does not automatically signal weakness. In many cases, it signals the exact opposite. Think about what must happen for RSI to become overbought. Buyers must consistently outnumber sellers. Demand must remain strong. Traders must continue accepting higher prices. Momentum must keep building. Those are signs of strength, not weakness. Yet many traders see an overbought reading and immediately begin betting against the trend. They are not responding to market behavior. They are responding to an assumption, and assumptions are dangerous. A market can remain overbought far longer than most traders expect. During powerful trends, every pullback attracts fresh buyers. Every small decline creates new demand. Momentum feeds on itself. As a result, RSI stays elevated while price continues climbing. This is why selling solely because RSI is overbought often becomes a frustrating experience. The trader enters a short position. Price rises. The trader adds to the position. Price rises again. Soon the trade is no longer based on evidence. It becomes an argument with the market. The market rarely rewards that behavior. Instead of asking, "Is RSI overbought?" consider asking a more useful question. What is price doing while RSI is overbought? That small change in perspective can transform the way you trade. If price continues making higher highs and buyers continue stepping in aggressively, the overbought reading is simply confirming strength. The trend is showing you that demand remains dominant. The indicator is not warning you. It is informing you. The real warning signs appear when price behavior begins changing. Perhaps RSI remains elevated, but price struggles to advance. Maybe new highs become smaller. Maybe buying momentum starts fading. Perhaps volatility increases as buyers and sellers battle for control. Now the context is different. The overbought condition itself is not the signal. The changing behavior around the overbought condition becomes the signal. This distinction matters because markets are driven by people. When traders see prices rising rapidly, emotions begin to influence decisions. Fear of missing out attracts new participants. Existing traders become more confident. Momentum accelerates. That emotional fuel can keep a trend moving much longer than logic alone would suggest. The market is not measuring what seems reasonable. The market is measuring supply and demand. As long as buyers remain aggressive, price can continue rising regardless of how overbought RSI appears. This is why experienced traders rarely treat RSI as a standalone sell signal. They use it as a piece of information rather than a final verdict. They observe the trend. They study price structure. They watch for changes in momentum. They look for evidence that buying pressure is actually weakening. Only then do they begin considering the possibility of a reversal, because overbought does not mean a market has gone too far. It means momentum has been unusually strong, and strong momentum often attracts even more participants, creating a cycle that can drive prices much higher than most traders believe possible. Most traders are taught a simple rule very early in their journey: when RSI becomes oversold, it's time to buy. The idea sounds attractive. If a market has fallen hard enough to push RSI into oversold territory, then surely the selling must be nearly finished. Surely a bounce is coming. Surely the opportunity is obvious. But the market has a habit of punishing obvious assumptions. Oversold does not mean buy. In fact, one of the most dangerous habits a trader can develop is buying solely because an indicator has reached an extreme level. Why? Because RSI is not measuring value. It is not measuring whether an asset is cheap. It is not measuring whether a bottom has formed. It is measuring pressure. And when RSI becomes oversold, the message is simple: selling pressure has been unusually strong. That information alone does not tell you when the pressure will stop. Think about a market that suddenly enters a sharp decline. Bad news appears. Investors rush to exit. Long positions are liquidated. Stop losses are triggered. Fear begins spreading from one trader to another. Price falls rapidly. RSI drops into oversold territory. At that moment, many traders see an opportunity. They believe the market has fallen too far. But what if sellers are still in control? What if fear is still growing? What if institutions are continuing to unload positions? The oversold reading cannot answer those questions. Only price behavior can. This is why markets often become more oversold after traders start buying them. The indicator reaches an extreme level, buyers step in, and then the decline continues. What appeared to be a bargain quickly becomes a losing position. The mistake wasn't using RSI. The mistake was assuming oversold automatically means reversal. Have you ever noticed how strong downtrends seem to ignore oversold readings? The market becomes oversold. Price falls further. RSI stays depressed. Price falls again. Many traders keep trying to catch the bottom because they believe the indicator must eventually work. But the indicator is already working. It is accurately reporting intense selling pressure. The problem lies in the interpretation. A market can remain oversold for much longer than most traders expect. During periods of fear, sellers are not concerned with indicators. They are concerned with getting out. That emotional urgency creates momentum. And momentum often carries farther than logic predicts. This is why experienced traders rarely buy simply because RSI reaches an oversold level. Instead, they begin asking better questions. Is selling pressure still accelerating? Are new lows attracting more sellers or fewer sellers? Is price collapsing with force? Or is the decline beginning to lose effectiveness? These observations reveal much more than the oversold reading itself. Imagine a market that continues making new lows, yet each decline becomes smaller. Sellers push hard, but price struggles to move significantly lower. Panic remains visible, but results begin diminishing. Now something interesting is happening. The same selling effort is producing less movement. That shift deserves attention. Markets often change character before they change direction. The crowd may still be fearful. News may still be negative. RSI may still be oversold. Yet beneath the surface, the balance between buyers and sellers may be starting to change. That is why context matters. An oversold reading inside a powerful downtrend means something different than an oversold reading after selling momentum begins weakening. One reflects ongoing pressure, the other may reflect exhaustion. The challenge is learning the difference. The indicator cannot make that decision for you. Your job as a trader is to observe how the market responds to the pressure being measured, because the best opportunities rarely come from the oversold reading itself. They emerge from the behavior that develops around it. They emerge when fear remains high, selling remains visible, yet price stops responding the way everyone expects. Most traders focus entirely on price. They watch candles. They watch breakouts. They watch support and resistance levels. Every decision revolves around where price is moving. But there is something many traders fail to notice. Momentum often changes before price does. This is one of the most valuable lessons RSI can teach. Think about how a trend develops. A strong uptrend does not suddenly reverse without warning. A powerful downtrend does not instantly transform into a rally. Before price changes direction, something usually begins changing beneath the surface. The energy behind the move starts shifting. That shift is often visible in momentum first. RSI helps reveal those subtle changes. Imagine a market that has been rising steadily for weeks. Buyers remain confident. New highs continue appearing. Most traders see nothing but strength. Then something interesting happens. Price makes another new high, but RSI fails to make a new high. At first glance, this may seem unimportant. Price is still rising after all. The trend appears intact. But look closer. The market has achieved a higher price. Yet momentum has not matched that achievement. Buyers are still pushing upward, but they are doing so with less force than before. Why does that matter? Because trends are powered by momentum. When momentum begins weakening, the trend may continue for a while, but the foundation supporting it is no longer as strong as it once was. This does not guarantee a reversal. That is an important point. Many traders see weakening momentum and immediately predict a market collapse. They forget that trends can continue even while momentum fades. The value of RSI is not prediction. The value is awareness. It helps you recognize when conditions are changing. Have you ever pushed a heavy object across a floor? At first, it moves quickly because force is strong. Over time, that force begins weakening. The object may continue moving, but not with the same energy. Markets often behave the same way. Price can continue advancing while momentum quietly slows. The crowd usually notices the price. The experienced trader notices the momentum. The same principle applies during downtrends. A market may continue falling and printing new lows. Fear remains high. News remains negative. Most traders assume the decline is healthy and strong. But RSI starts behaving differently. Each new low produces less momentum than the previous one. What is the market telling you? Selling pressure may still exist, but its influence is beginning to diminish. Again, this does not mean the bottom has arrived. It simply means the character of the move is changing, and changes in character often appear before changes in direction. This concept is important because markets are driven by human behavior. When a trend begins, participants are enthusiastic. Momentum expands quickly. New buyers or sellers enter aggressively. As the trend matures, that enthusiasm often starts fading. There are fewer new participants available. Early traders begin taking profits. The emotional intensity that fueled the move starts slowing. Momentum reflects those shifts. Price frequently reacts later. This is why RSI can be such a useful observation tool. Instead of focusing only on where price is, you begin paying attention to how price is getting there. Is momentum expanding? Is it contracting? Is the trend becoming healthier or weaker? These questions provide insights that simple price analysis sometimes misses. The goal is not to predict every reversal. The goal is to recognize when the market is no longer behaving the same way it behaved before. Because every major move eventually reaches a stage where momentum changes first. The crowd often ignores the change because price still appears strong. By the time price finally reacts, the evidence has already been visible for some time. Most traders believe the market is difficult to understand because it is driven by millions of decisions. In reality, markets often become easier to understand when you stop focusing on individual decisions and start focusing on collective behavior. The crowd leaves clues. The challenge is learning how to recognize them. This is where RSI becomes surprisingly useful. Many traders view RSI as nothing more than a technical indicator. They see numbers moving between levels and wait for buy or sell signals. But if that is all you see, you are missing a much larger story. RSI is often revealing the emotional state of market participants. Think about what happens during a strong rally. Price rises. More traders notice the move. Confidence increases. People who missed the beginning start feeling pressure to participate. Buyers become increasingly aggressive. As this behavior intensifies, RSI climbs higher. The indicator is not simply showing price strength. It is showing the effect of growing enthusiasm. The crowd is leaving a clue. Have you ever noticed how people become most optimistic after a market has already risen significantly? At the beginning of a trend, few people care. Confidence is limited. Participation is low. As the trend develops, more traders become convinced. As prices continue rising, certainty grows. Eventually, many participants believe the move can continue indefinitely. That shift in psychology often appears in RSI. The indicator reflects the increasing urgency of buyers, not because it can read minds, but because human emotions influence trading decisions, and trading decisions influence price movement. The same pattern appears during declines. When markets fall sharply, fear begins spreading. Investors worry about larger losses. Traders rush to protect capital. Selling becomes emotional rather than analytical. As that pressure builds, RSI moves lower. Again, the crowd is leaving clues. The indicator is capturing the intensity of behavior taking place inside the market. This perspective changes how you use RSI. Instead of asking, "What signal is RSI giving me?" you begin asking, "What are traders feeling right now?" That question often leads to better observations. For example, a market may become heavily overbought. Many traders immediately think about selling. But what is the overbought condition actually telling you? It may be telling you that buyers are highly motivated. It may be telling you that optimism is expanding. It may be revealing that traders are becoming increasingly willing to chase higher prices. Those insights matter because emotions influence future behavior. A fearful crowd behaves differently than a confident crowd. An exhausted crowd behaves differently than an enthusiastic crowd. RSI helps expose those shifts. Have you ever seen a market continue rising even while traders insist it is too expensive? That happens because crowd behavior is stronger than individual opinions. As long as enough participants remain willing to buy, price can continue advancing. RSI often reflects that commitment. Likewise, markets can continue falling even when many traders believe prices are already cheap. Fear overwhelms logic. Selling pressure remains dominant. RSI reflects that reality as well. The experienced trader understands that indicators are most valuable when they provide insight into behavior. Price shows what happened. Volume shows participation. RSI often shows the intensity behind the action. And intensity matters, because strong trends are rarely created by calm, indifferent participants. They are created by traders acting with urgency, conviction, fear, greed, optimism, or panic. These emotions leave fingerprints throughout the market. RSI helps reveal them. The goal is not to predict every move. The goal is to understand what the crowd is doing and how aggressively they are doing it. One of the most misunderstood concepts in trading is divergence. Many traders hear about it, memorize the definition, and immediately start searching for it on every chart. The moment they spot a divergence between price and RSI, they expect a major reversal. Then the market keeps moving in the same direction. Why? Because divergence is not a prediction tool. It is a warning signal, and understanding that difference changes everything. Let's start with a simple observation. In a healthy uptrend, price makes higher highs and momentum usually supports those highs. Buyers remain active. Demand remains strong. The force behind the move continues pushing the market upward, but sometimes something different happens. Price makes a new high. RSI does not. At first, this may seem like a small detail. After all, the market is still moving higher. Yet beneath the surface, an important message may be emerging. The market achieved a higher price, but momentum failed to achieve a higher reading. That means the trend is still advancing, but it is doing so with less energy than before. This is what divergence reveals. Not weakness in price, weakness in momentum. And momentum is often the fuel that keeps trends alive. Have you ever watched a car climb a hill? The car may continue moving upward even if the engine begins losing power. For a while, the movement continues. From a distance, everything looks normal. But the condition of the engine is changing. Divergence works in a similar way. Price may continue moving in the same direction, but RSI begins suggesting that the underlying force is not as strong as it once was. That information deserves attention, not because a reversal is guaranteed, because market conditions may be changing. This is where many traders go wrong. They treat divergence as an automatic buy or sell signal. The moment they spot it, they enter a trade. The market often reminds them that momentum and direction are not always the same thing. A trend can continue for days, weeks, or even months after divergence appears. The real value of divergence lies elsewhere. It helps you become aware of hidden weakness. Consider a strong rally. The crowd remains optimistic. News remains positive. Most traders continue expecting higher prices. Everything appears healthy, yet RSI quietly stops confirming new highs. Who notices? Usually not the crowd. The crowd focuses on price. The observant trader focuses on what is changing beneath the surface. That is where divergence becomes valuable. It reveals information that is not immediately obvious. The same principle applies during downtrends. Price continues making lower lows. Fear remains widespread. Many traders believe the decline will continue indefinitely. Then RSI begins behaving differently. Price reaches a fresh low, but RSI does not. What does that suggest? Selling pressure may still exist, but its intensity is no longer increasing. The crowd still sees falling prices. The trader studying momentum sees something more. The decline may be losing strength. Again, this does not mean the market must reverse. It means the character of the move is changing, and character changes often appear before trend changes. This is why experienced traders rarely use divergence in isolation. They combine it with price structure, support and resistance, volume, and overall market context. Divergence provides a clue. The chart provides confirmation. Think of divergence as an early signal that something deserves closer inspection, not a reason to act blindly. Not a guarantee, a clue. Because markets often reveal their intentions gradually, momentum weakens. Participation changes. Price behavior shifts. Only later does the larger move become visible to everyone else. One of the fastest ways to lose money in a strong trend is to assume that extreme RSI readings mean the move is about to end. Many traders learn that RSI above a certain level is overbought and RSI below a certain level is oversold. From that moment forward, they begin treating those levels as reversal signals. The problem is that strong trends rarely respect those expectations. In fact, some of the strongest trends spend a large amount of time at RSI extremes. That surprises many traders. After all, if a market is overbought, shouldn't it fall? If it is oversold, shouldn't it rise? Not necessarily. The answer becomes clearer when you understand what RSI is actually measuring. RSI measures momentum and pressure. It measures how aggressively buyers or sellers are pushing the market. So when RSI reaches extreme levels, it often means one side is demonstrating unusual strength. That strength can persist much longer than most traders imagine. Think about a powerful bullish trend. Price continues making higher highs. Pullbacks remain shallow. Every dip attracts buyers. Momentum stays strong. What happens to RSI? It frequently remains elevated. Sometimes it moves into overbought territory repeatedly. Many traders interpret this as a warning sign. The market often interprets it as evidence of strength. This is where confusion begins. Have you ever noticed how traders become eager to sell a market simply because it has risen significantly? They assume that because something has already moved, it cannot continue moving. But markets are not driven by what seems reasonable. They are driven by supply and demand. If buyers remain aggressive, price can continue advancing regardless of how extreme RSI appears. The indicator is not causing the trend. The trend is causing the indicator. That distinction is important. A strong trend creates strong momentum. Strong momentum creates extreme RSI readings. Many traders mistakenly reverse that relationship and assume the indicator itself predicts an immediate reversal. As a result, They spend weeks fighting trends that show no intention of ending. The same mistake occurs during strong downtrends. Price falls relentlessly. Fear spreads through the market. Sellers dominate. RSI remains deeply oversold.